Hi everyone and welcome to Inderes TV. Today here with Otto Pukk, CEO for Incap. Very much welcome.
Thank you very much.
You had a long day, you published your Q1 for 2023 and you have been answering a lot of questions already, but we will just continue today. And I hope that's fine.
Yeah, no, it is always good with interest, of course, in Incap, and I can understand with the latest release and so that there is a lot of questions, perhaps not on the Q1 release, but the one we did before that, and we try always to be open and answer as good as we can on the questions from our investors and others that follow us. So yeah, shoot, and I'll try to answer.
Brilliant. Last time we met, you just had closed the books for 2022 and that was a record year. And just 2 months later, you issued a profit warning. And you actually said when we met last time in February that the window is closing in and the visibility is not that good as it used to be. Is this a product of that or is it something else?
I think that is something we were discussing in general, that we see that component availability is getting better and we expect the visibility to close in a bit, because you should keep in mind that the past couple of years that then we have had extraordinary visibility in the MS business because our customers have been forced to order very much in advance to secure components and so on. As the component availability comes down, then of course there is no need to take such risks and visibility comes down more to normal. So this was not in what we at that point anticipated. So we were a little bit taken off guard or by surprise when our biggest customer told us that they have overstocked. That said, as I mentioned also in the webinar, yes, that this is a very big part of our service offering and what we do as a EMS player, that we help our customers to take care of the volatility in the business and we work very closely with them as an integrated part of their business to help them to succeed. And of course, this being our biggest customer, it shows of course a lot in our books, but this is actually something we are doing all the time, both up and down with working with our customer and optimizing their inventory and helping them to succeed in their business.
So you were kind of taken off guard as well with the information from the biggest client when receiving it.
Yes, yeah, of course we were, as we had the orders for the year and so on, that they had a need to now revise that we were taken by surprise of, but yeah, that said, now we are working very closely with them to provide a good solution and also that we haven't lost any business or lost any customer and we have very good relations with our biggest customer and this is, I would say, a give or take thing that they also understand our situation and we're trying to work out a solution that suits both parties the best way and that ensures us that we have good business relation and good prospects in the future as well for doing and developing the business.
You published your Q1 today, but since this is the major topic, we're going to dig into this profit warning a little bit more because this is what really people are interested in. The reason for the lower future estimates lies within there's not that the growth anticipated was not what it was, and they want to lower their inventories. In what size class are the orders that now have been moved to 2024?
Yeah, no, as was mentioned in the webinar as well. So our biggest customer is still expecting growth this year. But the growth is less than that they expected before, and that has then ended up with their need to reduce their inventories. Of course, they can't sit with too much inventories either. So that is, and as we said in the steering, that for us means that we have reduced revenue and reduced EBIT in this first bracket that we are talking about, this lower bracket that is from 0 to 20% in that sense. So that is what I can say. Of course, it's a moving target. There's still a lot of time left. It's all depending on of course how much this our customer sell and so as well, because the key here is that they purchase less than they have demand for, because then their inventory will reduce, and so it's still very much a moving target.
So good news, not lost any business, and the biggest customer is still projecting growth. This is kind of just postponed. But are you sure this is, I'm digging deeper and deeper here now, this is not a structural problem? You tell it's a temporary issue, but could there be something else there in the underlying demand on long term, or is this just a temporary issue?
No, as we see it, we strongly believe it's temporary, and that's the indications we also got from our customer side, and I want to emphasize once more that they are still seeing growth in their business. They have had a rapid growth the past years, and this growth continues, but perhaps on a somewhat smaller pace than they expected and geared up for here going into this year. And so overall, I think it looks very promising, and I don't have any concerns that this would be any structural issue or some other underlying thing. And as I said in the webinar as well, I think we shouldn't overanalyze it as well. Everybody who has worked with production and worked with selling out of stock knows that you can end up with overprojecting your need, and it's all in that sense. We have seen it before in that sense, us who work in manufacturing, and this goes up and down, and we're not worried that this would be anything more than an impact for us on the shorter term.
In February, we also talked about that the easing of the component shortage not necessarily is good for you, because it can be a bigger, it can raise the competition for your end customers. Is this something we're seeing now as well, or?
Yeah, no, that we haven't seen yet played out, but there of course is a risk that when components get more available, then that there is increased competition. But we haven't seen that, and if you look at the Incap's other customers, we have really good growth currently in almost all accounts, and so we don't see any tendencies for that kind of thing. But of course, it's all to say the component availability is how to say not yet fixed. It's getting better and better, but there's still issues, and let's wait and see. But yeah, for us, we wanted to bring that up to the ROS release as well, because most of our peer and nobody's talking about that, but clearly there is always two sides of a coin, and we playing with open cards and trying to educate many of our investors and those that follow us in our business. We thought that would be valid, because that is something we are discussing, of course, in the industry.
If you now take a look at the Q1 just published today, the numbers were really solid. I think you used the term solid. How would you summarize it yourself?
No, of course, it's an excellent Q1, and we have growth in both revenue and EBIT, and so it's a very good start of the year. Now, of course, with the news that we released afterwards, then it is what it is in that sense. But it I think shows the strength of our setup, and I think if you look at especially EBITDA percentage, and so shows how cost efficient our model actually is when we can keep it on high gear, and I think that gives faith for the future as well, because once we are over this hurdle or bump in the road, then we need to gear up again.
So what about this bump in the road? When will this be seen in the figures for this year?
I think as I mentioned during the webinar, of course we are starting to ramp down now during Q2 and the Q2, Q3, Q4. That is what we have said is we will see the impact. So those quarters we don't expect to be as good, of course, as quarter one, because there the effect will be. And overall, we expect the year to be both when it comes to revenue and EBIT lower than last year. So yeah, the effect is now moving forward in the numbers.
Yeah. So still to come, report-wise there. You're known, and you said several times here today, that your operating model is really efficient, and you have an agile way of operating. Is there any possibilities to generate the spare capacity that you're now facing?
Yeah, no, I think short term that will be very difficult to fill it up in that sense with something else. So we are growing other accounts and so as well. But I want to emphasize also on another message is that we believe that we will be able to maintain profitability in this. So we are not expecting now us to generate a loss or to go into red because of this downturn. That with the lower volumes we still expect to be able to earn money and with a relative good profitability in at least double digits. And so as our model allows, and we have with similar revenue levels that we are now expecting also been able to generate quite good profit that in the past, and I think that is also a key message that to take away from here, that it's not so that Incap now will stop making money on the business that we're doing. We are still continuing to doing that, but we will do it in a smaller scale than we did last year.
Yeah, that was my following question. How will you be able to defend your profitability and the margins you're so known for as well? But what about India? Because last time we talked about the Indian factory, and it's taking off now, the business there, and is it ready? The factory?
Yeah, no, our factory, the construction work is ready. Of course, there is some systems and so that we're working on long term that was already that in the plan. But of course, utilization of the factory or full utilization, that will take longer time now. India is the main factory we are working with our largest customer, and so it will take longer time than we initially projected to ramp it up. But also in India, we have perhaps the most flexible setup when it comes to labor and how to say the operating expenses in general. And so we are very much, I would say, prepared for this kind of volatility as well, without now accumulating a lot of cost of changing the demand in that sense. So of course there is some cost involved, but we don't see this as very significant in especially over the year or over some time, in that sense that this ramp down will take.
So, but if I understood it correctly, this new build in India, this is strictly linked to your this biggest customer, and
No. The new building, of course, we have calculated with all business we have in India when we have done this investment, but it's a long-term investment. I want to emphasize on that as well, and of course our biggest customer has supported that, but also other customer accounts that we are growing or we are looking to utilize the new factory. And we have been working on very tight floor space currently with the development we have had in India, and so the new factory is very welcome to get back to more normal how to say work conditions and so on. So I think it's of course affected by our biggest account as well, or we have a plan to utilize it for that as well, but not only. And I think it's a welcome addition to our factory in Incap, this third one anyway, even if the utilization will take somewhat more time than we initially expected.
Okay, so lagging in utilization, but the floor space will be needed anyway in the future.
Yeah, I'm quite sure that eventually we'll fill that up as well in that sense, but perhaps a little bit slower than we initially expected.
Okay, so and what about the personnel? I understood you have a really you're working with hired personnel or high?
Yeah, we have contract-based. So the majority of the personnel we have contract-based. So we take them in that sense on short-term on contracts, and these are quite flexible when it comes to adjusting those. So both up and down. So when we have needed extra capacity, and now when we need less capacity. So this is something we is part of our flexible setup.
So you're able to deliver profitability still, even though there will be some lagging with the Indian project.
Yeah, no, exactly. So we expect to be able to deliver profitability and how to say limit the cost that we have when with downsizing the operation after the demand.
Yeah. So now we have been focusing really much about the one biggest customer. What does the order intake look like for the rest of the customer base?
No, as I mentioned before as well, it looks very positive, and we see growth in almost all accounts that we have currently. So we haven't seen any big tendencies for recession or so on the market. In the contrary, where some sectors are growing very nicely currently. Of course, our big customers is so big part of the business, so it might not show always in the numbers in a big way, but we have very good development currently on the other accounts, and we have growth in all of the European units as well currently, and I think that is very positive to take away from this.
Yep. In February, we also talked about possible M&As, as you mentioned before today as well. Could you give us some more news about that? How has it been?
Once we have news around that, then I'm quite sure that you all will get to know. But we continue to look and evaluate on different opportunities, and we have a good team in place on who is working on evaluating different cases, and I'm quite sure that eventually then we will land something interesting in that field as well.
Mm. Do you think this will be happening during 2023, or what would that time span be?
No, let time show and tell in that sense, and then so of course we are continuously looking, and let's see.
Let's see. Interesting. I'd like to check about the numerical or more words around the guidance going forward, because we talked about several people asked about this earlier today, but the guidance, when you guide upwards, higher was about 0 to 20%, then clearly higher 20 to 40, and significantly higher 40 and above. When you guide downwards, is that to be?
It works exactly the same. So lower is 0 to 0 is actually 1 to 20, and then if you look at 21 to 40 is clearly, and then you have significantly when it's above 40%.
Okay, so the profit warning issued earlier this year in April was weaker, which means if we're talking figures, then it's
the profit warning we gave early in February was that we will be lower then, so we will be in this 1 to 20% bracket, both when it comes to revenue and when it comes to EBIT.
Yeah, and that was a profit warning in April.
That was the profit warning that we shot out now here before the release, and that we then repeated in the release, and the previous guidance that we had during Q4 and going into the year was that we will be higher than we were the previous year, but then we revised that and said we will be lower.
Yeah. Last question. You yourself purchased shares in the company in March, which is always a good sign for investors and the shareholders' perspective. How is your own sleep?
No, I think I sleep quite well in that sense, and of course, when it comes to my investment, that it really shows that there were no insider trading in that case. I bought perhaps on the wrong time, but I look at it long term, and I'm quite sure that even this bump in the road that we were able to maneuver us out of there's an I strongly believe in Incap and what we're doing here, and I think we have had a great development now, and if you look at this even this period over some kind of time frame, and we would look at some kind of average growth over the coming 5 years or the some years behind us and some years before us, then I still think we were going to look back on this and say it was excellent average growth on year, that even if we took now 2 steps forward and 1 back, we were continuing to go forward.
Well put there, Otto Pukk, CEO of Incap, skin in the game and sleeping well. Thank you so much for answering all these questions.
Yes, thank you.